Welcome back to the deep dive. If you are watching the markets right now, well, you know we are in a period of pretty intense turbulence.
Yeah, to say the least.
We're seeing these major sell-offs in, speculative assets across the board. AI stocks are struggling, and Bitcoin is really leading the charge in what looks like a classic market correction.
And this dive is, I think, absolutely crucial for you, even if you don't own a single Satoshi of Bitcoin.
Right.
Our sources consistently emphasize that Bitcoin has sort of evolved into this key leading indicator. It often signals exactly where the broader global risk market is headed, well before, traditional stocks or real estate catch-up.
And right now, it's signaling distress.
A lot of distress. And it's doing that despite what should be overwhelmingly positive news. Things like regulatory clarity, institutional investments from players like Harvard, and even accelerating corporate treasury adoption. It's a real puzzle.
Okay, so let's unpack this apparent contradiction. Our mission today is to cut through all that noise and really deliver the essential insights from our sources. We've identified four extremely compelling theories that explain why this sell-off is happening right now.
And we can group them. I mean, as you know, the financial world generally explains all market movement through two fundamental forces.
The technical force and the macro force.
Exactly. The technical, looking at charts, lines, patterns, and then the macro geopolitics, central banks, global liquidity flows.
We're going to analyze the current turmoil through both of those lenses, but we're also adding two pretty unique theories.
Yeah, one is about internal community politics, which is fascinating, and the other is about a massive sort of structural transfer of wealth.
That sounds like a fascinating cocktail of explanations. Let's jump right into the charts and what you call the self-fulfilling prophecy of the technical force.
Let's do it.
So for anyone unfamiliar with the trading floor, technical analysis can look like, just drawing squiggles on a chart. But there is a logic to it. It views the market not just as economics, but as this giant social system where specific patterns trigger specific, predictable human reactions.
And what stands out in the source material is the sheer, almost unbelievable consistency of the long-term cycles in Bitcoin.
What are we talking about here?
If you look at the last few major cycles, let's call them cycles 3 and 4, the time it takes for Bitcoin to move from a market bottom to a market top has been roughly 1,050 days.
Wow.
It's a staggering, 3-year-long cadence. It just repeats.
And if that wasn't enough, the pattern holds true on the way down too, right?
Correct. The move from the all-time high, or the AT, down to the all-time low, the ATL, has consistently taken approximately 364 days, a year.
So if we apply that?
Well, if we apply that historical pattern to the current cycle, which hit its AT on October 6th of this year, the prediction from many of these chartists is that the ultimate ATL, the generational bottom, could land around October 5th, 2026.
Regardless of whether you believe in technical analysis, you have to acknowledge that level of historical repeatability. It's something.
Something, yeah.
But the immediate trigger for this current sell-off wasn't that 364-day countdown. It was a much shorter, more definitive signal, right? The 50-week moving average.
The 50 WMA. That's where the cascade really started.
Okay, so break that down.
It's exactly what it sounds like. The average closing price of Bitcoin over the last 50 weeks. And the rule for chart followers is straightforward, and historically it has worked. In a definitive bull market, the price stays above this line.
So when the price breaks below it, it's not just a wobble, it's a real red alert.
It signals, for them, definitively, the end of the bull cycle and the start of the bear market. And the sources note that the critical price point for this cycle's 50 WMA was around $13,000.
And we broke below that.
We broke below it, and importantly, stayed below it for several consecutive weeks. That satisfied the criteria for a definitive technical signal, and that action alone caused a huge cascade of systematic selling.
From funds and traders who are just running automated programs.
Exactly. The machines just started selling based on that one rule.
Okay, that perfectly explains the technical catalyst. But if this is just a chart prophecy, how do we explain the macro anxiety that seems to be gripping everything, not just Bitcoin?
Right.
I think we need to pivot now to the second, much heavier force at play.
Yeah, the macro theory argues that the chart lines are, they're merely symptoms. The real cause is these invisible global forces, a massive structural change in global liquidity.
Global liquidity, so the amount of cash just sloshing around the system.
That's it. And there are two seismic shifts happening right now. We have to start with Japan.
And the great unwinding of something called the carry trade.
For decades, Japan has been the world's largest source of easy, cheap money. because of its zero and sometimes even negative interest rates.
So it was basically free to borrow.
Practically free. And this created the Japan carry trade. Huge investors, we're talking hedge funds, pension funds, they'd borrow billions of Japanese yen at next to no cost, convert that yen into dollars, and then invest that capital into higher yielding safe assets.
Like U.S. Treasury bonds.
Often U.S. Treasury bonds, yeah. They were guaranteed a profit simply on the interest rate spread.
Okay, so it was essentially guaranteed low-risk profit, provided you could manage the currency risk. But wait a minute. If U.S. interest rates are still significantly higher than Japan's, why would they suddenly unwind the trade now? Wouldn't that spread still be profitable?
That is the perfect question. This is where it gets interesting and a little complex. You're absolutely right to ask about the spread. The problem is twofold.
Okay.
First, Japan's rates are now rising, meaning the cost of borrowing the yen is increasing. And second, and this is more important, to execute this trade safely, investors have to pay substantial fees for currency hedging. It's like insurance.
Ah, so insurance against the yen suddenly strengthening against the dollar and wiping out your profit?
Exactly. So the rising cost of that hedging combined with the tightening spread effectively, well, it just wipes out the guaranteed profit margin.
So the free lunch is over.
The free lunch is over. The yield advantage disappears. Sometimes it even turns negative once those costs are factored in. And global institutional money doesn't care about nominal rates. It cares about risk-adjusted, hedged returns.
So when that return disappears, they have no choice but to unwind.
No choice. They sell off their dollar-denominated assets, stocks, bonds, and high-risk assets like Bitcoin to buy back the yen they owe. That capital outflow immediately tightens global liquidity.
And the second major shift comes from the U.S. Federal Reserve with the announced end of quantitative tightening, or QT, on December 1st. This is where we see that investor interpretation paradox you mentioned earlier.
Yeah, this one is tricky, the technical news. The Fed, stopping the removal of liquidity, should be taken as dovish and good for risk assets.
But that's not how investors are reacting.
Not at all. They're asking, why is the Fed stopping QT if the economy is supposedly so resilient? The move is being perceived as a massive warning flare.
So investors are essentially deciding that the Fed is hiding something. They don't believe the official reason about getting ahead of a mild recession.
Precisely. The dominant investor interpretation is that the Fed sees definitive signs that something somewhere in the financial system is fragile, if not already breaking. And since they don't want to be caught holding risk assets when that fragility finally surfaces, they retreat immediately.
And this connects perfectly back to Bitcoin.
It's the canary in the coal mine. It offers 2047 liquidity. So when these sophisticated funds decide they need to reduce risk right now, on a Saturday, they sell Bitcoin first. They can liquidate billions without waiting for the stock market to open on Monday morning.
That explains the external pressure, the charts, and the macro anxiety. But the third theory we have is, well, it's entirely unique to the Bitcoin ecosystem. It's like a philosophical civil war happening inside the technology itself.
This is a fascinating layer of complexity. The core question being fought over is just existential. What is Bitcoin supposed to be? Is it only digital cash? Purely decentralized money, like the original holders, the OGs, believe?
Or is it something more?
Or is it also a robust, immutable data transfer protocol capable of carrying much more than just value?
And this whole struggle hinges on a highly controversial update to the core code. Our sources highlight that this update, which was implemented years ago, removed an old data restriction called OP-return.
And we have to be impartial here. The source claims the development team behind this change was linked to some controversial funding back in 2015, which immediately raised red flags for the purists.
Right.
But regardless of the funding story, the technical consequence is what really matters now. Removing OP-return dramatically increased the size of the data that can be attached to any Bitcoin transaction.
So instead of just transferring the record of value, I sent you one coin, the network can now transfer large files.
High-resolution pictures, videos, and inevitably
NFTs and memes.
NFTs and memes. And this capability introduces two massive threats, as perceived by longtime loyal holders. First, there's the ethical and legal risk.
What do you mean?
Well, if the blockchain is now used to permanently etch illegal content onto it, the whole network could potentially become unusable, either through a regulatory crackdown or just simple reputational damage.
That's a huge ethical liability. Okay, what about the technical risk to decentralization?
This is arguably the bigger concern for the network's integrity. When people start spamming the network with huge files, like putting a 10 megabyte video into a single transaction, the size of the entire blockchain just increases exponentially.
Which makes it harder for regular people to run a node.
Exactly. If the chain becomes too large too quickly, it becomes prohibitively expensive and difficult for everyday individuals to run their own validating nodes on, cheap hardware.
And if fewer and fewer individuals can run a node, then fewer people are validating the ledger, which undermines the whole core value proposition of decentralization.
That's the identity crisis.
So that's the internal conflict.
Right. This internal fear about the future integrity of the network, is it money or is it a giant immutable filing cabinet, is causing some of the most philosophically committed OGs to sell. They're choosing to wait until the technology figures itself out.
And that adds a steady, consistent stream of selling pressure from the most loyal cohort.
A very steady stream. Now, let's look at the fourth and final theory, which is credited to the analyst Jordi Visser. He argues that this entire sell-off should be reframed.
Reframed how?
He says this is Bitcoin's initial public offering moment, its IPO moment.
The IPO moment. For an asset that has been trading for over a decade, that's a powerful metaphor. How does that translate into price movement?
It means that the handful of extremely early investors, the whales who are now paper billionaires from holding Bitcoins in single-digit dollar days, are finally able to cash out.
They can finally realize those massive profits without destroying the market in the process.
That's it. Because before, if even one of those early wallets tried to sell, say, $1 billion worth of Bitcoin, the sudden supply would have instantly tanked the price. They would never have gotten the full value.
So they were trapped by their own success. They had all this paper wealth, but they lacked the liquidity to realize it at scale.
That pre-liquidity barrier has now been shattered. The recent surge in institutional demand, fueled by the creation of Bitcoin ETFs, corporate treasury acquisitions, large sovereign wealth funds, all of that has created enough depth and liquidity for these early holders to sell billions without completely collapsing the price.
That is a mind-boggling scale. The sources reference specific anecdotes here.
They do. A single wallet cashing out hundreds of millions, and one firm, Galaxy Digital, apparently processing a staggering $9 billion Bitcoin sale.
$9 billion for a single person or entity.
$9 billion. So this isn't panic selling. This is a highly calculated patient liquidation strategy. What we are observing is a slow structural transfer of wealth from the few early investors to now the masses, the institutions, and the ETFs.
And this process can't be rushed.
Can't be rushed. They absolutely have to be methodical. They need to sell into sustained demand. And this need for patience means the process itself could take an extended period, which it potentially explains why the selling pressure is so slow and consistent.
And it aligns perfectly with the technical analysis timeline, that 364-day move to the ATL. The market correction is the necessary cost of this wealth transfer.
That's the theory.
So we have the self-fulfilling prophecy of the 50 WMA technical trigger, the massive geopolitical liquidity shift from the Japan carry trade and the QT paradox, the psychological sell-off from the internal identity conflict, and finally the slow structural transfer of wealth, the IPO moment.
Yeah.
So what does this all mean for the person watching their portfolio shrink right now?
It means it is entirely possible that all four of these theories are simultaneously true and exerting pressure. They're operating on a kind of weighted scale.
And what's the heaviest weight right now?
Right now, the global macro forces are likely the heaviest weight, causing that immediate anxiety. Meanwhile, the IPO moment is providing that slow, persistent downward pressure, just using the technical breaks as opportune moments to offload more supply.
And if we connect this back to the bigger picture, how are the longest-term institutional investors reacting to this, convergence of bad news?
For the most part, the majority of long-term holders are not selling their core positions. They are viewing this as a necessary, albeit very painful, structural correction.
They're holding strong.
They believe that the fundamental, powerful financial incentives of Bitcoin, its scarcity, its global reach, will eventually realign and fix any of these internal or external issues. Many are choosing instead to just dollar-cost average into the market.
Just buying small, consistent amounts.
Viewing this volatility as a sustained buying opportunity.
That is a powerful lesson in synthesizing diverse information rather than just succumbing to a single panic signal.
Yeah.
We started this dive talking about self-fulfilling prophecies in the technical charts. If everyone knows the 50 WMA is the signal to sell, they sell, and the prophecy comes true.
And this raises a really important final question for you to consider, long after we finish this deep dive. If these market patterns, the 1,050-day cycle, the 50 WMA rule, even the predictable unwinding of macro trades, if they become universally known, widely broadcast, and followed by everyone, will they still retain their predictive truth and power?
In other words, if everyone knows the prophecy, can human behavior truly prevent it from coming true? Or is the knowledge itself the mechanism that enforces the inevitable outcome?
Something to think about.
A deeply provocative thought for anyone navigating market uncertainty. Thank you for joining us on this deep dive into the 4 forces driving today's market correction.
Understanding the multiple layers of influence is really the only way to navigate this kind of complex environment. We'll see you next time.